Ghana has shown economic resilience, especially in the face of the COVID-19 pandemic. The economy has a diverse and rich resource base, including the manufacturing and exports of digital technology goods, natural resources such as hydrocarbons, and industrial minerals. The country experienced a rapid rebound post-COVID-19, showing a healthy gross domestic product of 6.6% for the third quarter of 2021 and an average of 5.2% for the first 3 quarters of 2021. And the country's economy remains strong despite the global challenges on the back of the pandemic, especially in emerging markets with risks such as financial stress and sluggish progress on vaccination. And while internally many are happy with Ghana's progress, there are those who have seen a few things that may raise concern. The country's dollar bonds slumped 10% in recent times, moving deeper into distressed territory as investors seemingly judge that refinancing debt in the Eurobond market won't be an option when the U.S. Federal Reserve hikes rates and budget targets remain elusive. With a debt to GDP ratio at around 80% against 61% at the end of 2019, the sustainability of Ghana's debt is a source of concern for investors. And that's not the only thing that someone should keep an eye out for concerning West Africa's second largest economy. Fitch downgraded Ghana to B negative with negative outlook. Now, the ratings agency said the downgrade reflects the country's or the sovereign loss of access to international capital markets in the second half of 2021, following a pandemic-related surge in government debt, noting that this comes in the context of uncertainty about the government's ability to stabilize debt and against a backdrop of tightening global financing conditions. While these concerns are noted, Ghana's government says it has plans on how to address its issues. Our focus today is on Ghana's path to economic sustainability. This is Business Edge. I'm Tolulope. Adeleru-Balogun. My guest today is Dr. Josh Bamfo. He's the head of transfer pricing for Africa and the Middle East of Anderson. Dr. Josh, welcome to Business Edge. Thank you so much for joining me.
Thanks, Tolulope, for having me too.
All right. So let's look at some of the positive things that's been happening. For the past several years now, Ghana has been hailed as really a great emerging market in West Africa and even across the African continent. But this recent Fitch rating from B to B negative has also been met with very strong reactions from Ghanaian authorities. So in light of the fact that we all are seeing the Ghana success story, should there have been some signal or some idea that this rating was going to come in light of the situation the country is finding itself? Should it really have come as a surprise, or should Ghana have seen it coming?
Yeah, thank you very much. I think if you put it in historical context, it shouldn't come too much as a surprise because as much as Ghana's economy has done well in when you look at other macroeconomic parameters, such as GDP growth rate, prior to COVID-19 in 2020, Ghana has been one of the economies in sub-Saharan Africa that have shown sustained high economic growth rate. So, for example, from 2017, we had GDP growth rate of around a little above 8%, and consistently had GDP growth rate for the next 2 years above 6%. We had the COVID-19 pandemic that had an adverse impact on the economy that led to a growth rate of 0.4% for 2020. But all indications show that for 2021, Ghana is going to bounce back and most likely end the year around 4.7 or around 5% GDP growth rate. So from that perspective, if you look at the expansion of economic activity, Ghana continues to be one of the shining stars in terms of the resilience of the economy in terms of economic activities. If you also look at inflation, Ghana has been able to bring inflation down under this current administration to around 8.5%, which is the midpoint of the target for the Central Bank of Ghana, which is called the Bank of Ghana, which is within a range of 6 to 10%. So if you look at those two major macroeconomic parameters, this is a very resilient and strong economy. However, debt management has always been a challenge. We all recall that in 2002, under the Kufuor administration, we entered into the highly and heavily indebted poor country program, which allowed us to get some debt forgiveness from international financial institutions such as African Development Bank and the IMF. So as of 2006, our debt to GDP ratio dropped significantly to 26.1. Prior to that, we had debt to GDP ratios, as high as 180%. But over time, that debt to GDP ratio started creeping back up. If you look at the beginning of the Mahama administration, going back to 2002 and 2012 and 2013, it used to be around 35%. By the end of his administration in 2016, we had added around 20% to that, and we're around 55, 56% debt to GDP ratio, which is pretty close to the 70% prohibitive mark, because that was the mark that was used to determine whether a country could qualify for HIPC and get debt forgiveness. So under the current administration, we've seen them managing this debt to GDP ratio pretty well from 2017 to 2019. It started around 56%, and by 2019, around 62%. So clearly, we're creeping towards that 70%, threshold. But nobody anticipated COVID.
Yes.
And with COVID, it became necessary that the government had to spend in areas that were vulnerable so that we don't deep hole, post-COVID. So what happened was unintended expenditures went up at the time that the economy actually contracted because of lockdowns. So your GDP also goes down, your revenue generation goes down, and that led to a big spike in the debt to GDP ratio towards the 80% mark, going above the 70% mark. So that in itself, for me, it's the COVID-19 impact that was surprising.
Yeah.
But we've always had a challenge in terms of debt management. And when we went to IMF in 2015, it was clear that we needed some kind of fiscal consolidation to bring down our fiscal deficits year in and year out and bring down our debt stock. So
okay, let me come in here.
Answer.
Okay, but because that provides a lot of context. And as you said, no one could have predicted COVID, and it threw many people's fiscal and economic plans out of the window, let's be quite honest. But let me stick with this Fitch rating right now. So they've explained this downgrade as a consequence of Ghana's rising dependence on Eurobond issuance. Do you agree that Ghana is, one, dependent on the Eurobond market? And then what do you see are the long-term effects of this dependency, especially when you have $2.7 billion, about 3.3% of the country's GDP, that goes towards sovereign external interest service and amortization payments in 2022. Is there a dependence that Ghana needs to watch out for?
I think there's some merit to that particular argument by Fitch. The reason why I'm saying that is that clearly for the government to first and foremost ensure that the exchange rate market, the foreign exchange rate market is stable, we've always had to have some decent amount of external reserves to cover our importation demands. And based on current data, we have enough external reserves to cover about 3 to 4 months of, importation, which is a pretty good thing. But the question is, where is your source of external reserve? And the argument that Fitch put out there was that year in and year out, Ghana has been going to the Eurobond market, to borrow foreign exchange in order to support the foreign exchange market. And that is not sustainable, especially when you have your debt stock to GDP ratio going way above the prohibitive mark, which is at 70%. So that is the angle that Fitch is coming from, that you cannot over-depend on Eurobonds to actually give you enough forex for you to then, stabilize your foreign exchange market. So there's some merit to that. They also did point to the fact that we did get $1 billion from IMF as part of the SDR loans to support our COVID, challenges. So that were some of the arguments that Fitch brought up. Clearly, you cannot continuously depend on Eurobonds in order to bring in foreign exchange, to support your foreign exchange market. Neither can you depend on Eurobond to finance your budget deficits year in and year out. So what is important for the leadership of Ghana to do is to actually be keen on this fiscal consolidation, which will mean that we reduce our year in, year out budget deficits and make sure that we don't finance these deficits significantly with, foreign, external loans,
Okay.
and those would really help. So, but unfortunately, what we're seeing for 2020 and 2021 is because of COVID, there's been the need for us to exceed our target fiscal deficit to GDP ratio of 5%. So, if you include the financial sector cleanup and the oil and gas sector and cleanup, energy sector cleanup, you had your fiscal deficit to GDP ratio for 2020 being somewhere around 15.7%, which is significantly higher than the 5% target that we agreed with the IMF. There's also an expectation that 2021, we're still going to have a significantly high fiscal deficit to GDP ratio, with the expectation that we'll get below that 5% threshold by 2024. So really, we cannot depend on the Eurobond market to help solve our debt situation as well as management of the foreign exchange market.
So I like that you say that Ghana cannot depend, but is it also a situation of Ghana not aggressively exploring other options? We had a recent conversation about how Tanzania is managing its debt, and the president there is not going to the Eurobond market. She's looking more at concessional loans from more multilateral lenders. We've also heard from Nigeria, and they said that they're also not going to be returning to the Eurobond market anytime soon, because right now it's even being described as prohibitively expensive, particularly for emerging markets. So is this a situation where Ghana needs to be more aggressive in exploring its other money-raising or revenue-raising options in the long run?
So there are two ways of looking at it. So the first has to do with your fiscal deficit on year in and year out. So on the fiscal deficit front, it's important that we generate enough revenue to fund our expenditures. So what are we seeing now? We've seen a case where the budget for 2022 has gone to Parliament. They've approved the expenditure side of it, but there's a particular provision on the revenue generation side of it, which is the e-levy tax, which happens to be taxing, electronic transactions, that is done through the mobile money and stuff like that. And that is hanging because both parties have not come to agreement as to how to pass it. That in itself sends the wrong message to investors. But if that is passed, I think it's expected to generate around 1.1 billion USD for 2022 alone. And that will help, minimize the amount of deficit, because once you have a significant amount of deficit, it needs to be funded, which means you have to borrow. Now, for you to borrow, you can either borrow domestically, which will be in your local currency, but interest rates are going to be high, or you go international, where you can go to the Eurobond, you get USD, but you finance that in USD. And that can be costly, especially if you don't have a very stable foreign exchange market. If you decide to go for concessional loans and you go to an international financial institution like IMF, then there's going to be conditionalities that come with it that can be anti-growth. So clearly, our work is cut out for us in Ghana. And I think the first step is for them to recognize that, or at least from the fiscal deficit point of view, they need to generate more revenue. And the argument has been the e-levy tax will help broaden the tax base so that they can rope in the informal sector that has not been paying taxes hitherto, and that will help us really bounce back. So there are a lot of creative ways that they are trying to generate more revenue in order to meet their planned expenditures so that they don't depend on borrowing, whether it's domestic, whether it's international or concessional, where it can come with conditionalities. At the same time, on the external reserves, we also need to be mindful and make sure that we have more exports, so that we can generate more foreign exchange so that we don't go to the Eurobond to borrow USD to support the foreign exchange market.
I like that you say Ghana is being creative. So when we come back, we'll look at what the government plans to do, because it seems that the government of Nana Akufo-Addo is banking on substantial increases in the revenue to help bring down the budget deficit, as you said. I'll share some numbers and you'll tell me what kind of picture this paints of Ghana's economic situation. You're watching Business Edge, and today we're looking at Ghana's path to economic viability and sustainability. One of the markets to watch here on the continent, but like many across Africa, did take a serious hit with COVID-19. Is Ghana back on the path of recovery? We'll see what happens after this. And still with me is Dr. Josh Bamfo. He's the head of transfer pricing for Africa and Middle East of Anderson. Now, the government is banking on a substantial increase in revenue to bring the budget deficit down from more than 12% of GDP in 2021 to a target of 7.4% this year and about 5.5% in 2023. However, Ghana's tax base is narrow, between 14 to 15% of the GDP. Moreover, the debt trajectory front is vulnerable to various shocks, particularly the tightening in U.S. monetary policy. Half of Ghana's public sector debt is denominated in foreign currencies, and almost 20% of its domestic debt is held by non-resident investors. Josh, I want you to paint a picture for me now. What does this say, these numbers and these figures? What does it say about Ghana's current economic situation where it finds itself? We see the targets of reducing the deficit for each year, this year and into 2023 as well. Also, aiming to widen the tax base, which is a target that many African countries have set in light of COVID. But for Ghana in particular, what does this picture say?
So clearly, this picture tells you that the current government is taking this fiscal consolidation, policy recommendation seriously. In spite of the shock that led to, us actually going way above the target of 5% of fiscal deficit to GDP ratio, there needs to be a consensus effort to bring it down. And if you look at it, the best way is to actually ensure that we're able to mobilize more revenue. And one way that they're doing that is to digitize the economy. So the digitization process, and there's something called Ghana Card, where now our source of identification is going to be digitalized, so that government can actually track every individual and most of our activities. So that's going to go a long way in roping in those in the informal sector, where in the past they never really paid their fair share of the taxes to the government. So that is one area. Being creative in coming up with some transaction taxes, such as the yield levy, which is more broad-based than your usual company income tax, which is usually targeted towards the usual traditional payers, that is the large companies. All this is going to help us actually bring down our budget deficit over time. But that is very important, that we bring the budget deficit. But it's one angle of the economy, which is the financial side of things. But making sure that those expenses go into helping, generate, investments in the market is going to be critical in terms of translating from, the financial side to the real economy. So why am I saying that? Today, Ghana wants to position itself as the industrial hub in not only West Africa, but across Africa. So they need to create an enabling environment for both domestic and foreign direct investment. To do that, you need to make sure that when investors come in, the economy is vibrant enough and the cost of doing business is cheaper. You need to bear in mind that they're going to be in direct competition with neighboring countries such as Nigeria. So to do all this, those expenses in capital projects have to be done. If they don't do it, then the economy cannot grow. So it's important that we have those expenditures, but we need the revenues to be able to embark on those expenditures. And that's the reason why the creativity of making sure that we widen the tax net, more people pay their fair amount of taxes, and they are channeled to the appropriate sectors that need to be developed, so that we can actually create more job opportunities and the economy improves in a sustained manner over a long period of time. That's the only way we can increase the welfare of the average Ghanaian and make this country a prosperous country again.
So earlier you mentioned inflation, so I want us to talk about that. We saw that high inflation prompted the central bank to raise the key interest rates by 100 basis points to 14.5% in November. And it's very likely that there are going to be further increases, and that would also increase government borrowing conditions and it will make it more expensive. But we've also seen that it's likely that there are going to be some financing constraints that come into the picture. What do you think these constraints are going to be? Because some of the fears are that the adjustments are going to come particularly in public spending, which could come at the expense of economic recovery.
So clearly, I don't think currently inflation is one of the biggest economic evils today, because inflation has been hovering around the single digit, 8.59%. Which is actually within the Bank of Ghana's band target, between 6 to 10%. For us to put in proper context, if you look at Nigeria's case, just recently, as recent as March of 2021, inflation rate was as high as over 18% until it dropped down to 15.4 in November, and recently went to 15.63 in December of 2021. So if you have an inflation rate in Ghana hovering around 8.59%, I don't think that is the biggest, economic evil that needs to be tackled, although it needs to be maintained. I think what is very clear to both, the central bank in Ghana, from a monetary policy point of view, as well as the Ministry of Finance in terms of fiscal policy, is how to bring the economy back to its high economic growth. So we cannot really have a contractionary monetary policy or contractionary fiscal policy. We need to be able to stimulate the economy and get it back on track. However, this debt challenge is one thing that could constrain the gains that we've made in terms of bouncing back and having high economic growth rate. And so getting that fiscal consultation done, making sure that we have enough tax revenues to finance our critical expenditures, and making sure that we actually attract domestic and foreign direct investment to the key sectors is what is going to bring the country back on track so that we can have sustained high economic growth and create opportunities for the masses of Ghanaians who are facing either underemployment or unemployment, which is a big problem in the country.
So you've answered parts of my final question in terms of the creative ways. We've talked about tax revenue. We've talked about, of course, making sure there's an enabling environment for domestic and foreign investors as well. And you also talked about the key sectors. So that's where I want us to end this conversation now. What are these key sectors for Ghana's economic sustainability, for it to be viable beyond 2021, beyond 2022, to also pick up for the economy as well? What are the sectors you think government needs to continue to focus on, and one or two things they need to do to drive those sectors so that they can help the country recover and also progress?
So I think Ghana, the current administration has a very clear plan. First, digitization is very important. Having, the whole world is going tech-wise. So this digitization program has been very successful, both on the public sector side and the private sector side. I think some improvement, especially in the fintech space and the tech side, will be very helpful, because we can see Kenya and Nigeria doing a lot of good works there, and there's been a lot of foreign direct investment coming into that particular tech space. Secondly, Ghana has a very clear industrialization program, because when you have industrialization program that feeds on agricultural products, what you do is you create job opportunities in the agriculture sector, which is the largest largest in terms of being able to create jobs even in the hinterlands or the villages. And there's a linkage between that agriculture sector and the industrial sector, where raw materials from the agriculture sector becomes inputs for the manufacturing, processing of finished products for both local consumption and exportation. So in making sure that our agri sector continue to boom and continue to feed the industrial sector, the manufacturing sector, is going to be critical. And investment in the industrial sector to make sure that their policy of one district, one factory, which is the idea of having cottage industries in various districts across the nation, such that job opportunities are not only centralized in the big cities such as Accra and Kumasi, but you can have job opportunities that cut across all regions and all districts. And that's a very laudable policy that needs to be funded. And I believe that the current administration is making sure that they have funds to actually fund such projects. Thirdly, the service sector will continue to be the highest contributor to GDP. And we need to make sure that we create an enabling environment for it to thrive. But if you bring everything together, there's a need for support, and we already have the financial service sector that has been cleaned up to make sure that we have robust banks supporting this industrialization drive. So all in all, when I look at the path that the Ghanaian economy is on, it's on a path to a very sustained high economic growth rate, as we saw prior to COVID-19, where we had a consistent GDP growth rate of over 6% for 3 years, similar to what we had in Cote d'Ivoire, what we had in Rwanda, and what we had in Ethiopia. So these are the 4 countries that showed promise prior to COVID-19. I believe that the same countries, with the exception of Ethiopia dealing with some kind of political strife, could actually bounce back and continue to show those sustained economic growth and create job opportunities for the teeming citizens of those countries.
All right, and we'll leave it at that. Dr. Joshua Bamfo, thank you so much for being on Business Edge. We look forward to having you again.
Thank you very much, Tolulope.
All right. And what we see is that there is a clear line in the sand for many African economies before COVID-19 in terms of the moves they were making for economic sustainability and, of course, for increasing the economy's power to change lives. COVID-19 has not fully gone, but it might be on its way out, and some of these countries, as my guest highlighted, could be right back on that path of economic sustainability and viability. We'll keep our eyes out on them right here on Business Edge. What we are watching up next is NC4 to watch. A few stories to keep your eyes out for. Stick around. And some stories we're watching to see how they develop. We start in the southern parts of the continent, while striking workers for a consumer's good maker Clover have taken to the streets in Johannesburg, South Africa, to remove the brand from shops' shelves to protest the company's restructuring and loss of jobs. Workers at the company have downed tools for 9 weeks owing to a restructuring that has caused mass retrenchment, an increase in shift duration from 9 to 12 hours, a 20% pay cut, as well as compulsory work on Saturdays and public holidays. Groups representing the descendants of South Africa's earliest inhabitants, the Khoi and San, are in court to try to halt the construction of Amazon's new 70,000 square meter Africa headquarters on land that they regard as sacred. The former lived as hunter-gatherers for tens of thousands of years, and the latter joined them as pastoralists more than 2,000 years ago. Official court documents show that 9 executives of electricity distribution firm Kenya Power have appeared in court on suspicion of failing to prevent a fault on the grid, which caused a nationwide blackout last week. The East African country experienced a blackout on January 11th due to what Kenya Power said was the collapse of some towers supporting a high voltage line. Power was restored after several hours. And finally, Nigeria has announced plans to partner with Egypt in the area of technical support in the transmission and distribution of electricity in the country. Nigeria's Minister of Power, Abubakar Aliyu, announced this during a meeting with his Egyptian ambassador to Nigeria, Ihad Awad. And that's Business Edge for today. Thank you so much for joining us. You know what to do. Follow us on social media, download our mobile app, and of course, subscribe to our YouTube channel. I'll see you again soon.